What's up? It's Thrax. We're back for our third video in our footprint chart trading series. In our first two videos, we went over the basics. If you missed those, you might want to go back and watch it because it may make it easier to understand what we're talking about here today. But in this video, we want to go a little bit deeper into order flow and talk about a framework utilizing big trades, absorption, and heat levels on the DOM to understand the auction or the battle between the buyers and the sellers to make informed trading decisions. So we're essentially looking at big trades get executed on the tape. And what I mean by big trades is I'm not talking about like big trade as in a good risk to reward or a big P&L. I'm talking about large size being executed at a specific level at market. And then we're looking for whether there's a continuation or a reversal following that big trade, and then we're utilizing the depth of market or the DOM and heat levels. You don't need them, but I use them as targets or levels that we want to watch for. So what exactly is a big trade? Like I mentioned before, a big trade is essentially where unusually large size is executing at a specific level. So it's representing a market participant with meaningful capital stepping in. So unlike smaller prints, these orders actually carry information value because they signal intention. So someone with size is trying to get positioned into a trade, and we need to pay attention to that. And you might ask, why do we need to pay attention to that? It's because aggression in the market is what's actually driving the tape or moving the auction forward, or not, right? We all understand that there's aggressive orders and passive orders. Passive orders or resting orders don't move the market. We should all know this, but resting orders don't move the market. So price is only moving when someone is crossing the spread with size. So like an aggressive buyer hitting the ask or an aggressive seller hitting the bid, trying to push price in one direction or get their order filled. So when a big trade hits the tape, the market's really going to react in one of two ways. The first way being acceptance or continuation. So a big trade hits the tape, price then expands in the direction of that trade, and it's essentially showing us that the aggressive side's pressure overcame the resting liquidity, and it's likely that price is going to continue in that direction rather than reverse. The second way that the market reacts is it could be absorption or exhaustion, essentially a reversal. So if big trades are hitting the tape and price begins to stall or price doesn't move or even reverses, then it's essentially telling us that the resting liquidity is absorbing all of that aggressive pressure instead of letting price actually move through. By watching the interaction between the buyers and the sellers on the footprint chart utilizing something like the big trades indicator, you can see whether the aggressive orders are actually moving the auction forward or if large passive players are dominating at that level. So just for context, this is MNQ, which is micro NASDAQ futures. This is the 5-minute chart. These big trades, these numbers, they are going to be probably higher, obviously, than if you were looking at the mini contracts or the mini NASDAQ futures. So essentially what we're looking at here is this is the footprint chart, right? Now we're zoomed out a little bit, so we don't have the numbers showing on the bid and ask ladder, but for this scenario, we don't really need it because we are utilizing a few different things here within the candle itself. So we have our red candles that are bearish, the blue candles are bullish. Within each candle, we have the volume showing us where contracts were traded, and as well as the POC, or the point of control, highlighted here with these yellow rectangles. And then we have big trades right here, one right here, one right here, here, and here. The big trades are represented by these bubbles here. Now, the bubbles have a number inside of them, and essentially what that number is telling you is how many contracts were actually executed at that level. So in this example here, we see that we're caught in a chop or a range on the 5-minute chart. Sellers try and push further down, they fail to do so. Buyers step in here and here, trying to push price higher, and they fail. Sellers come in again, And then what ends up happening is we break out of this range and go into a distribution of price where we have massive sell orders aggressively hitting the bid, pushing price down. So this is essentially telling us now, here's the move, we are going lower. And when you see this happen, this is a perfect example of something that you do not want to try and reverse. If you see all of this selling pressure coming in here, and maybe you had a level right here or whatever, maybe let's say you were looking at some type of level right here, and you're considering buying in this area. When price is coming down here and you start to see all of this pressure here, 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 you do not want to buy it here. If your level was right here, you do not want to buy it, because at that point you're essentially stepping in front of a train. I don't want to step in front of a train, and I hope that you guys don't want to step in front of a train either, because you are going to have your stop loss just get obliterated really quickly. So you can use this to understand where price is trying to move to and when the move is actually being initiated, or the catalyst for the move to actually move in the direction with the trade. The second example here is when we are looking for a reversal. This is the 5-minute chart again on micro NASDAQ contracts. We see a 5-minute candle come down, come down, come down, and then we see our first bullish candle. Now we might be thinking, is this actually going to reverse right here, or is this just stalling out before we continue lower? Now when this candle does print, this candle right here, when it does print bullish, we see buyers stepping in here and buyers stepping in here. So essentially what that's indicating to us is, let's say that we have a level sitting here and we were looking for a reversal off of this level, and we wanted to make sure that this level wasn't going to just get ran through. So let's imagine that as price is playing out, we are moving with speed to the downside, making you question whether or not that your level is valid still, or if it's just going to get sliced through. Once we bounce off of here, if this is your level, we want to see if buyers are actually stepping in, validating that level, saying that they're trying to take back control of the auction and move price higher. So when we see these big trades step in, we acknowledge them, but we don't necessarily see these big trades and then immediately enter into the position, because we need to see how price reacts. So just as a note, as a reminder, when a big trade enters the market, we're not using that as a signal to enter a trade in the same direction as that big trade. When the big trade enters the market and it gets executed on the tape, we're looking to see how price is going to react following that big trade. So in this instance, we have the big trades here. Then we have this 5-minute candle open up, it pushes down and creates a wick where these big trades were executed, and then closes bullish. This is our indication that this is potentially going to be a reversal to the upside, and we can try and position ourselves into this trade for a reversal. So in summary, big trades show real size stepping in with market orders, and they matter because it's basically saying that someone isn't waiting around, they're taking initiative. They're trying to move price. The big trades are an attempt to move price, and if price follows through following that big trade, then we can look for a continuation. If price stalls after that big trade or big trades, it's absorption or potentially exhaustion. So it might be aggression being absorbed by resting liquidity, essentially saying that they're getting dominated at that level and they're not going to break through it. So the market's either going to accept the trade and price is going to expand with it, or it's going to absorb those trades and price is going to stall and then potentially reverse. We look at the big trades coming in, and also where are they coming in, because they often show up at key spots. So these are things like VWAP or highs and lows or heat levels on the DOM, because if there's 300 contracts sitting at a specific level, obviously we're going to need to enter with some pretty decent size at market to be able to push through the resting liquidity. So it makes those areas useful as reference points for continuations, reversals, or targets. In this example here, we are obviously in an uptrend, okay? And I don't know about you guys, but for me, sometimes I attempt to try and top tick a trade, right? I try and enter in at the top of a uptrend and think that I'm about to catch a reversal, and when it works out, it's great, but a lot of times it doesn't work out. Now, when I utilize the big trades indicator, this is what I'm looking at when we're in an uptrend. So for example, we see big trades step in here, here, and a ton of big trades step in here. Buyers are obviously looking to push price higher. Within this area, even though there's a red candle right here, within this area, there's no sign of any type of selling pressure. There's no sign of any type of reversal that potentially could be happening to the downside. When we see something like this, or when I see something like this, if I really want to take price lower, this level right here needs to be invalidated, meaning that sellers need to get past this area, because oftentimes what's going to happen is if a lot of buyers are entering in right here on this candle, if price comes up and comes back into this level right here, they're going to want to defend their position. Into this level right here, they're going to defend their position. And then again, buyers step in and push price higher, buyers step in and push price higher. So when you're looking at this, you can determine that maybe right now is not the best time to try and catch a reversal. We see a ton of aggression trying to push to the upside. Again, why are we going to try and step in front of a train? Now, yes, if you scalp, who cares? You could have just shorted right here, caught like 5 or 10 points to right here, and that was your trade, but that's just not how I trade. I'm looking for bigger moves than that. So I need to be aware of these areas when they show up here, because I don't want to reverse this uptrend until this becomes invalidated. One thing we need to talk about is we need to talk about resting liquidity. I need to explain what that is. So resting liquidity is essentially limit orders waiting in the book at specific price levels. You can see them right here, right here. All of these are passive orders, right? They're limit orders. So they're basically traders saying, I'm willing to transact here, but only if price comes to me. So it's not price movement by itself, it's potential liquidity. And that's a key word, potential, because at any time, these orders can get pulled from the book and they will no longer be there. This heat level can exist all the way until price comes up here, and then they pull the orders and then it disappears. So it's potential liquidity that can be absorbed or fuel moves once aggressive orders interact with it. So most traders, the way they think about it is they equate resting liquidity with obvious spots like previous highs or lows, or round numbers like psychological numbers, like how it is here at 25,300. We have orders sitting right here. Or let's say that in this scenario, there was a low here and there was a high here, and maybe orders were sitting right above the highs and orders were sitting right below the lows. Yes, those levels do attract orders, but that's the surface view, because in reality, resting liquidity actually shows up all across the book. Okay, so it's not just based on obvious technical levels, and you can utilize the DOM or you can utilize heat maps, and you're going to see a couple things, either a big area right here or a stack of areas right here, levels. These are where orders are sitting, or you can see these thick bands of heat, and depending on whatever color you're using, it will show up as a thick band of heat, telling you that essentially there is resting liquidity sitting right here. They may align with highs and lows, but they can also appear at hidden levels such as VWAP or large trader inventory zones or iceberg orders that refresh. But it is key that not all liquidity is equal, because some of these orders are here to actually get filled. Some of it's there to act as a wall, meaning that, it doesn't even want to get filled and is trying to essentially scare price away. And some of it is spoofing. And if you don't know what spoofing is, it's essentially where someone is placing large limit orders on the book and then they are just removing them, trying to pull their trades away before price actually gets there. They never had an intention of it getting filled in the first place. So it is important to understand that when you're looking at heat levels, or if you're trying to utilize them as a target, because you could be targeting this level, let's say, and maybe this wasn't a high, right? Maybe this wasn't liquidity sitting at a high, but rather it was just somewhere in the middle of the market abyss, and you're targeting this as a level, and then halfway to the target, the orders disappear. Okay, well, now where are you targeting? Are you going to target the same level? So it is important to understand that, yes, these can be removed. They're passive orders, they're limit orders. It is important to note what they can be, because they could be buy side bids, so traders waiting to buy at a certain price. They could be sell side offers, or traders waiting to sell at a certain price. So they could be acting as like stop limit orders, where, you know, traders can say that these are stops and stops, but it's not only stops, it's also breakout entries or just passive liquidity of large players providing fills without chasing price. And so why do these matter? Well, they matter because these heat levels, or these levels on the DOM, often act as magnets for price. The market tends to test where liquidity is, and to push through them, aggressive buyers or sellers, the big trades, they have to step in with size, because if big trades can't push through, then the level is going to absorb and actually hold. So now that we understand what big trades mean and what resting liquidity looks like, let's put them together and see how they actually shape up the battle between the buyers and sellers, and how we can actually use it, or how I use it, to make informed trading decisions. I'm looking at the interaction between big trades and resting liquidity in two main ways. The first main way is I'm reading the live auction, so I'm looking after a big trade prints whether there's going to be a continuation or absorption. So big trades punch through a heat level, the market accepts that aggression, and we look to ride the move towards the next liquidity zone or the next target that we have. Or in some cases, big trades continuously, or even once, slam into a heat level, but price stalls, it reverses, and the resting liquidity then absorbed all of that aggression, and we can look for exhaustion reversals off of that same zone. The way that I actually look for entries is I'm using big trade levels as trade references. So when big trades print at a level, that price often becomes the reference point, because participants who committed to that size will often defend their position. So this is a example here of a real trade that I took, because there's two ways that you can really use this. If the market has a big order here for longs, and we have a heat level sitting right here, what we can look for is we can look for price to come back, retest this level here, and we can watch for the defense of this level, and we can enter with the trend using the big trade as the risk anchor to then target the liquidity that we're looking to target. And we can also use it for failed attempts, so absorption or exhaustion. So if, let's say, this was our high and big trades come in and hit this level, but they fail to continue to push price higher, then what we can do is it can be a signal for trap traders, and that can set up a reversal trade as those positions actually unwind and then start to come lower. We'll take a deeper look at some of these examples here. In this example, and these are all from actual trades that I took during the day, when I saw big trades step in right here, big trades step in right here, when this candle opened up right here, what I was looking for is I marked out a level here, and I'm waiting to see whether or not this candle is going to respect this. Now, if this red candle came down and closed down here, I would be less likely to try and take a continuation to, let's say, this being the target. Once this candle closes within this range, we have a stacked imbalance here, we have big trades, we can enter in a long position to continue higher, and we can set our stop loss either right below this candle or right below these lows to then continue our trade higher. In this example, what happened here is we were chopping for a bit. This was closer to market open this day, and I saw buyers step in here. So when this candle opened up, my first thought was I'm looking for price to actually respect this level and come down and continue higher. But what ended up happening, as you can see, is we have massive sellers hitting the bid, pushing price lower, They do it again here with a lot of contracts, 770 aggressive sellers hitting the bid. So what we can then do is utilize this level where the big sellers stepped in, likely to try and defend their position after big buyers failed, and we can set our stop loss at the top of this candle and look for a position to then come down into here. And as we see more sellers come in the market, we know that we're on the right side of the direction of the market and where it's moving. So again, big trades show us aggression. Resting liquidity shows us where that aggression actually matters. And the combination, the acceptance versus the absorption at key liquidity levels, it's telling us the story of the auction. It's allowing us to read it, and it's allowing us to see what buyers and sellers are doing in real time. So there's no guessing involved. There's no predicting involved. It's just reading and reacting. And that's how we can utilize this framework to try and take trades, try and take winning trades. Now, obviously, there are times where the market is chopping and order flow can be all over the place and you can potentially read it wrong. But at the end of the day, I find it very useful for my own trading. And the last part of this video is I'm just going to take you over to the ATOS platform right now, show you how to get big trades actually set up on your chart so you can utilize them. Okay, so here we are on ATOS. If you want to add the big trades indicator to your chart, what you're going to do is you're going to click up here. It's going to say indicators, and we can search for big trades. Now, there's a couple important things to note here is I usually, and I'm just going to tell you how I keep it on my chart, but you can mess around with these settings and put it to however you want to put it. But I keep it on cumulative trades. I do not keep it on separated trades. And the most important thing here, besides the visuals, is the filter. So you can either auto filter it, which is what I recommend, because what you're essentially doing when you're auto filtering the big trades is it's accounting for the actual volume that's coming through on average for each candle and specific level. And if it's unusually large, then it's going to print a big trades bubble. Now, you can take it off and you can decide that you only want to see big trades pop up if it's 300 contracts or more, or if you want it to be more sensitive, 200 contracts or more, or if you only want to see the biggest trades possible, you can do 500 contracts or even 900 contracts. And it is important to understand though that the numbers I'm talking about right now is for micros on the NASDAQ. So these numbers are going to be different if you're trading gold, if you're trading GC, MGC, CL, MCL, ES, MES, or even just NQ. These numbers are going to be different. But what I would do is I would keep it on auto filter depending on what time you usually trade, whether it's New York session, Asia session, London session. You're going to find what the typical amount of contracts are that are going to signal for that specific slot of time that's going to signal a big trade for your asset. Then after that, you can refine it or optimize it as you want when it comes to a specific amount, whether you want it to be, more sensitive or less sensitive when it comes to identifying these bubbles. And then what happens as well is on the visual side of things, when you first load it up, it's going to show as a rectangle. I like to keep it as a circle. I just think it looks nicer, but you can keep it as whatever you want, a diamond, a rectangle, a triangle. It doesn't matter. And then that's about it. As far as for colors and stuff, you can change the colors and then you just click add to chart. I'm not going to do that because I already have it on my chart and I have it how I want it to look like. And so we can then see them on our chart. So we go back on the 5-minute chart and they will start appearing on your chart, showing you where the big trades were actually stepping in. You can go back and you can back test this if you want. You can just put it on and look at them while you're live trading and walk forward and forward test it. But it is important to mess around with them a little bit, understand how it's actually working, practice on actually reading the auction and how price is interacting or reacting after big trades are being printed, and then you could begin to use them for trading decisions. I don't always show it on my screen, but I do always have this up, and I am always looking at this when I am trading. The last thing to mention though is that I do not only take trades based off of big orders. I have my strategy, I trade my strategy, and I use footprint, and I use things like the heat levels, the DOM levels, the big trades, the POC, the volume, the delta. I use all of that in confluence with my actual strategy, and I recommend that you do the same. If you're not familiar with this platform, this is the Atos platform. If you want a 14-day free trial, you can click the link in my bio. They have a good backtesting engine. They have great order flow footprint charts. They do offer Heatmap as well, and you can have these same indicators. If you want to get your chart set up the same way that I have my chart set up, you can go look at my Atos settings video that I posted a little bit ago, and you can download the file to then import the template that I have here to make your chart look like mine. Although it's not going to have the big trades in here, so just add it the same way that I showed you how to add it. And then, yeah, that's it for this video. I will catch you guys in the next footprint trading series video, and until then, peace.